Welcome to the Deep Dive, your source for getting past the headlines and really understanding what's driving the economy and markets. Today, we're diving into the latest news. What do you really need to know? Our mission, as always, is to cut through that information overload, give you the key trends, short-term, long-term, and maybe some surprising insights.
Yeah, and look, the big theme that just jumps out is inflation. It's really back front and center. It's hitting everything,
Yeah.
Fed decisions, stock performance. We're going to try and connect those dots for you.
Okay, let's unpack this then. We got some pretty important economic data just before the holiday weekend, that PCE price index, the Fed's preferred measure. What did it tell us?
Right, so that came out last Friday. The main number, the monthly increase, was plus 0.2%. Exactly what was expected, actually. It followed a 0.3% rise the month before, so no big surprise there. But the really interesting part is the core inflation. That's stripping out food and energy. It rose 2.9% year over year.
Okay, 2.9%.
Yeah, and that's significant because it's the highest reading for core PCE we've seen since, well, February 2025.
Wow, since February 25.
Exactly. And the implication here is it's not just high, it's persistent. It's stubbornly elevated. I mean, it's still well above the Fed's 2% target. It's been over 2.5% since way back in early 2023. And maybe more importantly, it's actually been ticking up for the last 4 months.
4 straight months of increases. That doesn't sound great for hopes of quick relief.
No, it really doesn't. This kind of persistence, especially if it's driven by services, which tend to be stickier, it just limits how much the Fed can ease up. It makes that dovish pivot everyone talks about much harder. The fight against inflation might be longer than, some people hope.
That 2.9% core definitely sounds stubborn. But, the economy's complex. Are there other signals? Maybe some bright spots that kind of counterbalance this a bit? Because I remember there was some worry about a weak jobs number recently, but other things seemed okay.
That's a good point. It's definitely a big picture. Consumer sentiment, for example. The Conference Board's index actually beat expectations. Came in at 97.4. The forecast was 96.5. So consumers are feeling slightly better than predicted, despite inflation.
Okay, that's something. And didn't we also get revised GDP numbers?
We did, yes. And they were strong, too. Second quarter GDP was revised up to 3.3% growth.
Up from 3.1%, right?
Exactly, from 3.1%. So the economy is showing some real resilience. It's not just collapsing under the weight of higher rates, but, that strength, combined with the sticky inflation, it kind of weakens the argument for the Fed to rush into rate cuts, doesn't it?
Yeah, it puts them in a tough spot. So looking ahead, this week feels crucial then. What should we be watching?
Absolutely critical week. We've got the ISM report on Tuesday, that's manufacturing, and then the big one, the jobs report on Friday.
Right, especially after last month's weak reading and those downward revisions to previous months. That's going to be watched very closely, I imagine.
Extremely closely. And what's fascinating here is the timing. This week's jobs report, plus the August inflation reports, CPI and PPI that are coming up soon. These are basically the last major pieces of economic data the Fed gets before their meeting on September 17th.
Ah, so these are the deciders.
Pretty much. They're poised to be the key factors determining whether or not we actually see a rate cut in September. The Fed will be poring over this data.
Okay, but despite that high core inflation number we talked about, the market odds for a September cut actually went up last week.
They did, yeah. Probability rose to about 90%, up from 84% the week before. And for the rest of the year, the chances of getting 50 basis points or more in cuts, that's 0.5%, also ticked up to 86% from 81%.
So the market heard that PCE number, saw it was high, but not catastrophically high. Not enough to derail the expected cuts.
That seems to be the interpretation, yes. Elevated, stubborn, but maybe not bad enough to force the Fed's hand away from an easing path just yet.
Okay. Now, I want to shift gears a bit. Away from the immediate data, there's something else our sources highlighted, calling it a building ominous cloud. Yeah. This relates to the independence of the Federal Reserve itself. This feels like a really big deal, potentially.
It is potentially a very big deal. Specifically, President Trump stated his intention to fire Lisa Cook from the Fed's Board of Governors. Now, if that were to happen, it would be unprecedented. The first time a president tried to remove a sitting governor, he said on August 26th, will have a majority very shortly. It's a direct challenge.
A direct challenge to the Fed's traditional independence. How did the market react to that? Was there panic?
The initial reaction was actually pretty muted. I think investors understand there are significant legal hurdles, procedural hurdles. It's not straightforward for a president to just, take control of the Fed like that. So they aren't pricing in an immediate dramatic shift just yet.
Okay, so maybe not immediate panic, but looking at the bigger picture.
Right. I mean, this will undoubtedly be challenged in the courts, regardless of the outcome there. But even the attempt, it's a concerning echo of history. The last really serious challenge to Fed independence was under President Nixon back in the early 70s.
And what happened after that?
Well, what followed was years of very high inflation and high interest rates. Now, correlation isn't causation, but the precedent is worrying. It really underscores the importance of perceived independence. Michael Farr at Hightower Advisors put it well. He said, basically, even the perception of the Federal Reserve being under the influence of the Treasury weakens credibility, which is probably the most important tool the Fed has.
Credibility as a tool. Explain that a bit more. Why is that so vital?
Because so much of what the Fed does relies on trust. Trust that they'll stick to their mandate, price stability, maximal employment. Trust that their decisions are based on economics, not politics. If markets and the public lose that trust, if they think policy is being politically driven, then the Fed's announcements, their guidance, their actions, they all become less effective. The inflation expectations could become unanchored. It makes managing the economy much, much harder. Okay, so with all that swirling around sticky inflation, resilient growth, this Fed independence question, how did the actual markets digest it all last week?
Yeah.
U.S. stocks had an interesting ride.
They did. Stocks did sell off a bit on Friday, right after that PCE report. That's kind of a textbook reaction to hotter inflation data. But it wasn't a massive sell-off. And you have to remember, the S&P 500 had just hit a new record high the day before, on Thursday.
Right. So for the week as a whole, U.S. stocks actually finished up slightly.
And we've talked before about small cap stocks being really sensitive to rate cut expectations. Did that trend continue?
Oh, absolutely. Small caps were the clear winners again. As those September rate cut odds firmed up, small caps just took off. For the entire month of August, they were up a really remarkable 7%.
7%. Wow. Compared to the S&P 500.
S&P 500 was up only 2% in August. So small caps really outperformed. Shows you where the optimism about lower rates is flowing. Just for the week, looking at other segments. Large caps were up about 0.3%, growth also 0.3%, value a bit better at 0.6%. The NASDAQ was basically flat.
So mostly modest gains outside of that small cap surge. Okay, but where it got really interesting, I thought, was gold, reaching a record high.
Yeah, gold had a fantastic week, closed up 3.3% at a record high. That's a classic sign investors are anticipating rate cuts, which usually means a weaker dollar, making gold more attractive. It's also that safe haven appeal, perhaps.
And year to date, gold's performance is pretty stunning, isn't it?
It really is. Up 32.5% for the year. Compare that to the S&P 500, up 9.8%. Gold has been a huge winner in 2025 so far.
Okay, let's talk about a specific stock that everyone was watching, NVDA. Huge earnings release on Wednesday. How did that play out?
Right, NVDA. So they beat expectations again. Both earnings and revenue were better than forecast. Revenue growth was an amazing 55.6% compared to last year.
55.6% growth. But the stock still went down.
Slightly, yes. It was down a little bit after the announcement.
Why? How does it happen?
Well, the market was already expecting incredible results. It was priced for perfection, maybe even beyond perfection. And now I think the market is starting to look further ahead and factor in the idea that eventually this explosive growth has to slow down. As AI becomes more widespread, as competition potentially increases, that trajectory has to moderate at some point.
It's hard to keep growing at that pace forever.
Exactly. I mean, look at their growth over the past 3 years, annualized revenue growth of 91%. That's just unheard of for a company this size. So even 55.6% growth, which is fantastic by any normal measure, can seem like a deceleration relative to those kinds of expectations. The market is always looking forward.
Makes sense. And quickly, what about world markets? How did they compare to the U.S. last week?
They lagged. Developed market stocks were down about 0.6% for the week. Emerging markets down 1.0%. Europe and Japan saw sell-offs.
Okay. Underperforming the U.S. for the week. But bigger picture.
Bigger picture, year to date, it's actually the opposite. Developed markets are up 21%, emerging markets up 19.2%. Both have significantly outperformed the S&P 500's 9.8% gain this year.
And a lot of that is the weaker dollar effect.
A huge part of it, yes. The dollar falling about 10% this year really boosts those international returns when you convert them back into dollars.
Got it. And finally, bonds. How did they react to the PCE data and everything else?
Interestingly, bonds actually rallied last week, even with that hotter PCE number.
Rallied. So yield went down.
Yields went down, yes. The yield on the 10-year Treasury fell about 4.8 basis points for the week, closing at 4.23%. It strongly suggests bond investors, just like stock investors betting on small caps, are also anticipating that September Fed rate cut. They're pricing it in.
Okay, so let's try to wrap this up. It was a really complex week. We've got inflation that just won't quit, economic data pointing different ways,
Yeah.
this serious political challenge brewing around the Fed's independence, and then markets reacting in nuanced ways, small caps surging, gold hitting records, even NVDA facing a reality check despite great numbers.
Yeah, and understanding how all these pieces fit together, the core inflation number, the Fed's credibility, market sentiment, it's really crucial. Whether you're, prepping for an interview, making business decisions, or just trying to make sense of the news you read every day, seeing these connections gives you a real edge.
Absolutely.